Yeah, I see it. I see it. Good morning, everyone. It's my pleasure to call this meeting of the Sinking Fund Commission to order. And the first item of business on our agenda is the approval of the minutes from our September meeting. Is there a motion?
Motion to approve.
Is there a second?
Can I second them even though I wasn't there?
We'll give you permission.
Okay, I second them.
The motion was made and properly seconded. All those in favor say aye.
Aye.
Motion is passed. The first item, the second item on the agenda this morning is it Golub? Is that how you pronounce that? Capital presentation?
Yeah.
So I think Christopher, if we could, or Bill, if we could, let's get this underway.
Sure. And just as kind of a refresher reminder, for folks who were in the room who may not have been there was, we've heard from this firm as a recommendation as part of the alternatives asset allocation that the commission approved many months back. Over the last couple meetings, there's been some, I think, prudent and justified questions around not only some of the loan, whether it's default rates or discharge rates, but then I think, just as importantly, particularly at the last meeting, there was a discussion around DE&I and employee demographics and what the firm was doing to address those now and going forward. With that in mind, we asked representatives from the firm to come back to provide a brief presentation, and then, of course, to answer questions from the commissioners. Alex, I don't know if you had anything to add or if the commissioners had questions for us before the firm came in.
No, just, you see the, their DE&I report that was sent over as part of the materials. I think some of the feedback that was presented last meeting was, looking for more concrete goals as well as accountability towards achieving those goals. So that's been set forth in this document. It's up to you, I think, to determine whether that meets your needs. And you can hear, I think, they've shown commitment to this. The head of the firm is here today, so I urge you to ask pointed questions and determine if what they've set forth is appropriate.
Let me ask a question. We had some data that was provided to us at the last meeting that broke down the diversity component of this firm by Black and African American and Hispanic, and that was our primary focus. Do we have the ability to bring that chart up so they can see why we have concerns?
I can pull that, Don, if you give me a minute or two, and I'll shoot it over to Bill so that can be loaded up onto the screen for your reference and Rebecca's and Fran's. Just give me 2 minutes.
Especially what was on the bottom portion of that report, which showed 0% in the, I'll call it the investment manager or executive rank, whatever you want to call it. That was buried down at the bottom of the report. And we had to ask Bill to move the screen down in order to see it. So I want to make sure that that's prominent.
Chris, I have it, but it requires a password to be able to pull that up. So we would need the password.
I have it unlocked, Bill, so I'll shoot it over to you. You should be able to open it.
I'll just add one thing before they come in. I have not been on this. Nick has been handling this. Nick has kept me up to date. Nick's wife had a baby girl last night. So Nick is now a dad. I did not ask Nick to be on this call this morning, but I did get a picture. I did get a picture of the baby girl. So
thanks for sharing.
Sure, sure. So I'm here and Nick did keep me up to date on everything and on the back and forth and what the concerns were. Just wanted to let you know that.
Thank you. And Chris and Alex, can we make sure that they stay on point and are precise concerning the diversity issue? Because
Yep.
we know everything else about the investment. We don't
Yep.
need to stay back into those areas.
Yep, and Bill, I just sent it to you. I copied Don, Rebecca, and Fran. So you'll all have it, and then Bill, you should be able to put it on the screen. And yeah, Fran, when they come in, I'll make that point explicit to them again when they start.
Okay, it should be visible on the screen now. I can move it to whichever number you need.
Yeah, can you move it down, Billy, where the 0%, where the 0% is?
That the
Maybe it's 1%. I don't know.
I think that was the chart you were referring to, Don, right? The detailed breakdown, or no? Is that not the right one? They
Well,
sent over a couple different things. I just
the
want to
one
make
that I
sure
was-
I'm getting the
The
right
one
one.
that I was looking at was the one that said racial/ethnic diversity, diverse breakdown.
Oh, this is it. Yeah. Investment professionals, African American, 0%. That's it. Yep. That right there, Billy. Leave it right there.
Yeah, that's the one I wanted to focus on. And what I was asking is, again, I don't know what the date of this material is. I'm assuming that it's probably August of this year. And
Yep.
I wanted to know if it was appropriate for us to share this chart with the presenters.
Yeah, I mean, they presented it to staff and PFM. They knew it was going to be discussed with the commission. They actually broke it down into more detail than they had for other clients or potential clients at our request. So, they were made aware of public records laws and things of that nature. I don't see any reason why you wouldn't be able to discuss that in an open forum with them.
Okay, all right. Then I think if the other commissioners are comfortable, I think we're ready to begin.
Yes, sir.
Don, I looked for a date. I don't see one on there. So it may have been prepared before that, but I don't see an actual date.
Okay,
It's pretty recent, I can tell you that. It's very recent.
Okay, I'll let them in.
Thanks, Bill.
You're good to go, Don.
okay. Good morning.
Morning.
Thank you guys for joining us this morning. We are the members of the Sinking Fund Commission, and we wanted to give you an opportunity to present your DEI program. Certainly, we thank you for sharing the information with us. I know we all had an opportunity to review it. And let me preface my conversation by saying DEI is not an easy topic to discuss in certain cases. And culturally, it's not something that you can implement successfully overnight. It takes a long-term commitment to it. We understand that. I will also tell you that, for 44 years, I was a senior manager with Wells Fargo. So I understand that even if you have a commitment to it, sometimes progress is slow to come. So with that, I'm going to turn it over to the presenters to walk us through their commitment to diversity, inclusion, and equity.
Thank you. Thanks for giving me the opportunity to come in and talk to you all today. It's a little bit awkward to do this over Zoom, but I appreciate the opportunity. My name's David Golub. I'm president of Golub Capital. I'm joined by Tim Kleiman, who I think you've already met. Tim heads our ESG efforts, and he reports directly to me. And I appreciate your opening comments. I really get why I'm here. I hear you that DEI is something that's really important to the commission. And if I were in your shoes, I'd be thinking the same thing. I'd want to know, is it something that's really important to the partners that the commission is going to be working with? And so in this case, the question is it really important to Golub Capital? And what I want to say very emphatically, very crisply, very clearly is yes. It's important to me personally. It's important to the senior leaders of the firm. It's really an important part of our culture and values. We're really proud of the fact, and you can see it in the materials that you've received, that more than 50% of our team is women and people of color. That's not something that many people in our industry can say about their firms. But we also think we've got a lot of work to do on DEI. We all do. Our firm does, our industry does, our society does. And to your point, this is not something that can be approached casually. This is hard work. And this is not work that can change things overnight. So I want to start by talking about some steps that we're taking to address a component DEI issue that's important to me, and I know it's also important to you, and that's increasing the number of Black investment professionals who work at Golub Capital. And I want to focus on words. You've no doubt heard words from lots of different managers who preceded me. Words are just words. I want to talk about a set of specific steps that we've taken in the last year in order to move us forward. So we're now posting open roles on some new career platforms. There's some new career platforms that have been created that are geared toward candidates from underrepresented populations and specifically Black professionals. One of them is called Jopwell. I don't know if you're familiar with Jopwell. If you aren't, I highly suggest that you take a look at it and that you encourage your other investor partners to use Jopwell. Our early experience with it's really positive. It's a career advancement tool that's focused on Black, Latinx, and Native American professionals. We've also changed the way we're posting roles. So we're using a number of different partners that are focused on developing talent. One of them you may be familiar with, it's the Robert Toigo Foundation. We're also right now in the midst of solidifying a partnership with another one that looks very promising. It's called the Posse Foundation. Third thing we did was we started an internship program this last year. It's with a nonprofit organization called the Opportunity Network, or OpNet. We had our first OpNet interns this summer. We talked about this, I think Tim talked about this last time. We've also broadened the range of colleges that we recruit from and post opportunities at. In particular, we added 12 HBCUs this year. We rolled out firm-wide unconscious bias training. Many firms do this just for managers. Many firms don't do it at all. We thought it was so important we did it for every single employee. And final step that we're in the process of implementing right now, we're actually going to the search firms we use. We use a lot of search firms. We hire a lot of people into the firm from other financial services firms. So we're going to all of our search firms in writing, and we're telling them we want to see more Black candidates, and that their ability to deliver on that is going to influence how much business we give them on a go-forward basis. Now, you said something really I completely agree with in your early comments. DEI, this isn't just a Golub Capital issue. It's an industry issue, and it's a societal issue. I mentioned we hire a lot of our people from other firms, so the lack of diversity in the financial services industry, it's one of the headwinds we need to deal with. So I want to talk for a few minutes about things that we're doing to help our industry improve diversity.
David, can I ask a question? Sorry.
Yeah,
okay. David, I'm Rebecca Reinhardt. I'm a city controller and
nice to meet you.
Pension board member. Thank you. Nice to meet you. You just mentioned this series of changes in the way that you advertise job positions, the way that you recruit, and perhaps with implicit bias training, the way that, with implicit bias training, the way that people, I'm sorry, is someone trying to talk?
Yeah, who is that?
I don't know. Chris, do you know who that is? Who-
It appears they've been muted. It looked like it was Tori Lynn. Yeah.
Does she work for the city?
Bill?
No, I believe it's an outside reporter.
Okay.
It's muted.
Okay, so my question is just that, when were these changes implemented, and have you seen any early change or positive result from these actions?
So these are changes this year as part of a set of initiatives that we've implemented as part of our recommitment to DEI. It's not my honest answer is I think it's early to look at results from this.
Okay.
I'm encouraged, but I wouldn't want to tell you that I can evaluate success metrics of these changes at this time.
Okay.
The only thing I would add to that.
I was gonna go down that same path because as I was reading your material, well presented, but it seems as though most of your initiatives started in either 2019 or 2021. Would that be accurate?
I would describe our commitment to DEI as being something that goes back to the very beginning of the firm. But I would agree with you that in recent years, we have taken steps to further enhance our commitment to DEI, as have many firms. This has been a period of time in society when I think we all have looked at what's going on and reevaluated whether we're doing everything we should be doing in order to address DEI concerns.
Hi, David. This is Fran Bielli. I have a question. I'm also the executive director of the large municipal fund, and we've been active in DEI for a long time, over a decade, and our numbers show that. And you indicated that you believe that DEI dates back to the beginnings of the firm. And I'm not trying to put you on the spot, but I will ask you a difficult question. How can you explain 0% African American investment professionals if DEI indeed dates back to the beginnings of the firm, which is, I believe, 1994? Is that right?
So that's not an accurate statistic. We have across the firm about 5% African American participation. It's about 7% in non-investment roles. It's about 2.5% in investment roles. It's not good enough. I'm not defending that. It's not good enough. We have a commitment to improve that, and I think we're on a path to be able to do so.
I might have misspoke. I meant to say senior leaders as investment professionals, and you can look on the screen if you would like. It's 0%.
I agree. The senior investment professional is underrepresented. I'm not going to tell you that I'm happy with that statistic. What I will tell you is that this is something that we're looking to change over time. It's not something that is easy to change because the underrepresentation of Black investment professionals in our industry is something that's been going on for decades.
Yeah, we're familiar with that because we do a utilization study each and every year of not only the diverse firms that are in the investment industry, but the diverse personnel that is in the investment industry. So we're very familiar with those numbers, but we appreciate that explanation. But because we desire to have diverse firms, because we desire to do that in the larger municipal fund, we have almost 25% of assets under management for diverse firms. So I understand what you're saying about the industry, but I think we appreciate your renewed commitment at this point to doing that. But I don't think the numbers necessarily show that this same enthusiasm was there since the beginning of the firm. And I think, anyway, I don't want to get a discussion about it, but that's what the numbers say to me.
Fran, if you don't mind, I'd like to just make one observation. I think this connects to Rebecca's question, which is we recognize, I think, more vividly over the last 2 years, that diversity is a big issue and there are important sub-issues within there. So we might think we're making a lot of progress on capital D diversity while still needing to do a lot of work specifically to attract Black investment professionals. So I think that the new piece for us is really more deliberately focusing a set of tactics to address that piece of the talent pie, as opposed to kind of diversity with a capital D.
Thanks, I appreciate it.
Yeah, I think if you were to go to page 5 on your presentation that you sent to us, and you look at those percentages, if you didn't dig behind the numbers, you guys would get an A. But when you dig behind those numbers, you will see that in terms of Hispanic and African American, that the track record is not overly positive.
Just to follow on that, do you think if we were to invest with you and follow you over the course of 1, 2, 3 years, that we would see a change in African American numbers for your firm? Do you think that is where you're going and where you would feel comfortable being held to having that we would expect to see improvement there?
I expect to see improvement.
Okay. Thank you.
You mentioned that you had established, I think, and I don't want to misquote you, that you had established a working relationship with a number of historically Black colleges and universities. Did I hear that right?
We have begun this year to develop a new program where we're posting positions directly at a set of HBCUs.
Okay. I think that's certainly a step in the right direction. Do you have the names of those historically Black colleges?
Yeah, I can run through them really quickly. I apologize that I'll be reading from a piece of paper. Alabama A&M, Alcorn State, Clark Atlanta University, Delaware State, Fayetteville State, Langston University, Livingstone College, Morehouse, North Carolina, AT&T State University, Rust College, Spelman College, and Xavier University of Louisiana.
And contact has already been made with those institutions in terms of your commitment?
That's correct. We've reached out to several others and have not yet gotten traction with them, but I would say that we think there's an ample opportunity to continue to increase our engagement here.
And would you also consider some type of financial support to these institutions, or one or two of these institutions in areas of concentration that might be beneficial to you? I don't know if that would be economics. I don't know if that would be accounting, investments. But I was looking at your philanthropic strategies. So would that be one that you would consider?
That's interesting. I'd like to take back that recommendation and think about that. You're right that we have a very active impact philanthropy program. The newest impact philanthropy program component might be of real interest to you. We are in the process of finalizing a third Golub Capital Social Impact Lab. It'll be a $6 million gift to the University of Chicago Booth School of Business and the Chicago Urban League. And together they're building a program called Ignite. And Ignite is going to be focused on accelerating the impact of high potential nonprofits serving Black and historically marginalized communities in Chicagoland area. So we are very active in our impact philanthropy program in addressing issues of racism and addressing issues that are important to historically marginalized communities. So I think your suggestion is an interesting one for us to think about.
Thank you.
David, do you as a firm provide tuition assistance, tuition reimbursement for diverse employees who are seeking to increase their education?
We provide training and development programs probably unmatched in our industry, both through internal programming and through tuition support for employees who are interested in doing things, degree programs or non-degree programs outside of the firm.
Okay.
So yes, that's an important part of our value proposition for our employee base. It's to give them opportunities to grow and develop in their careers.
Thank you.
Look, I got a little bit off track in some comments that I was going to make at the outset, but just to summarize where I was going to go, I really appreciate your inviting us today. This is important work. These are difficult conversations. There's an awkwardness to them. I want you to hear loud and clear. This is really important to me personally. It's important to my senior leadership team. It's hard. This is not easy stuff. We're working both internally, we're working with our industry through ILPA and through other industry groups. We're working at a societal level through our impact philanthropy program. You know, DEI has enormous attention at Golub Capital. Are we perfect? No. Do we have a lot of work to do? Sure we do. My argument would be everybody does. But I want you to leave this conversation understanding very, very clearly that we understand we've got work to do here.
Well,
Hey, David, I have a question. A few minutes ago, you talked about some of the broader industry organizations that are focused on, correcting this imbalance within the broader community. What are some of the mechanics that those organizations, I forget the names, but what are some of the mechanics that those organizations are adopting to correct the imbalance?
David, do you want me to start on this? Yeah, no, this is, I'm our main point of contact with the ILPA Diversity in Action Initiative. This is a recent initiative founded by the Institutional Limited Partners Association. It consists of a series of quarterly roundtables where, my peers at other organizations in private equity and private debt firms candidly compare notes on challenges and exchange ideas about strategies. As a concrete example, our engagement with the Twigo Foundation was a direct result of some suggestions we heard from one of our peers that they had had a lot of success with that program too. It's important to us that when we join these bodies, they're not just kind of talking shops that don't go anywhere. One of the areas that ILPA has focused on that we're keeping an eye on is just kind of standardizing the way firms like us kind of capture and report on issues of diversity. That's, and we are very supportive of standardization because that helps you as investors make kind of intelligent comparisons between firms that might think of things slightly differently. So that's one example. There's also ILPA has a portal that enables folks to share best practices and resources on there. It's a start. I think I think that organization is still trying to figure out where it can be most impactful, and we're happy to be part of that conversation.
And I assume, feedback from this meeting will be shared with other members as well. Right? This is the kind of thing that you would get together and discuss at your next roundtable.
I'm happy to take that as a follow-up for our next roundtable.
Look, I think your voices are a critical part of catalyzing the kinds of systemic change that's needed here.
Thank you.
are there any other questions?
Not for me, Doug.
If there are no other questions, David, we certainly want to thank you for taking the time to reemphasize your commitment to diversity, inclusion, and equity. We really appreciate it. And we will be coming back to you in the very near term in terms of our decision. Thank you very much.
Thank you. Appreciate your time.
Thanks.
Thanks.
Thank you.
Thank you.
Don, you're clear.
Okay. I think my position here, I'll just be candid, is I really didn't expect David to be on this call. I think that shows a commitment to improving the conditions at his firm. I think Rebecca asked him if he would be able to commit to making positive change as they move forward over the next 2 or 3 years. I think he responded positively to that. I think we have the ability to track and monitor that. And the other thing is, I think the dialogue that they have begun to have with historically Black colleges and universities, where you have, unlimited number of qualified individuals, and if they would take the time to invest in 2 or 3 of those institutions, they could certainly move those numbers pretty significantly, pretty quickly. So my thoughts would be that we give them a chance to demonstrate their commitment by monitoring them over time. And there's no question that that this initiative, in my opinion, really only recently began. Because had it started 5 years ago, I think you would see that they would have been further along in the process. But the key is that you start, and the key is that you invest in this initiative. And if we have the ability to track and monitor it, I think I would be comfortable. But that's my position. I'll look forward to hearing from the other commissioners.
I'll add. I mean, I think that makes a lot of sense. I think that if we go the route of investing with them, if they could do even, I don't know if we have any precedent for this, but doing an annual presentation of where they are, I think that would show how serious we are about it, and also hold them to what they've said and committed to. And if we can help push for diversity, I think that's a good thing. But I think that, and Chris mentioned this to me, but it's true that the pension board, the city's main pension board, as well as this one, have been ahead of the curve on diversity issues, and much of Wall Street has just woken up, honestly. And so that's where I am.
So I'll be honest, I'm a little suspect of what they said about DEI. I think it's strictly for business purposes. And if they were committed to DEI, a firm that's been open since 1994, we would certainly see some better numbers. Now, I agree, Don, with you that all of the steps that they're taking, including the list, so far the list of HBCUs, are very good. One thing David said, he said, our voices are needed for systemic change. No, David, your voice is needed for systemic change, and your voice was needed since 1994, and there was no voice until all of the current social events occurred, and now all of a sudden, Golub is, to both feed in on diversity. That's a good thing in the long term, but it's clearly being done only for business reasons, I believe. But where they're at now is a good thing. I mean, the Posse Foundation, I'm very familiar with. I've known about that for a number of years. That's a great foundation. So the Job Well is also a very good foundation. The Opportunity Net, the OpNet internship program, they're all very good. And I think that's good going forward. If I was in favor of the underlying investment, I would say all the DEI things are good. I do have concerns about the underlying investment from now I was not here for the asset allocation, and I'm not looking to revisit the asset allocation at this time. But for a fund that is almost 76% funded with a 7% assumed rate of return, I'm not exactly sure why we're getting into alternative assets at the rate of 1 and 20% at this point. So I think for that reason, given the funding percentage, given also, you may remember back when we had the discussion concerning the consultant, that we talked about not wanting them to treat us as an OCIO client. We did, at the meeting where this presentation was made, determine that this particular product was offered to 16 other PFM clients, and that they're invested in it. I feel like this is a bit of an OCIO situation. I remember in the Golub presentation, I remember I asked the question specifically about whether they take an ownership interest in any of the underlying companies that they invest in, and they said, no, not really. Then later they came back and corrected that answer and said, oh, yes, we do. We do take ownership. And then Don, in answer to your question, they said that's how they get the returns that they get, because you were asking them how they do get their returns. And they later came back and corrected the incorrect answer that they gave us about taking an ownership interest. They also
Fran,
told us.
Fran, I just want to step in and say that I misspoke originally and said they don't take ownership. That was not Golub. That was me.
Okay. And then they also indicated that part of their business, part of the reason that their business strived was because it was very difficult for banks to make loans in this segment of the market, especially after 2008. Well, we've all been reading recently that banks are making tremendous amount of loans because they have an excess of cash. So I'm concerned about that also. I'm concerned about the fact that banks are opening up into making more loans because they have such excess cash. And my concern is that whether or not that, I'll call it an advantage, right? Or the edge that they may have in that lending sphere may not be there because banks are now opening up, making more loans because of all the cash that they have. So there are some of my concerns about the investment. And given the funding rate of the sinking fund, I'm not quite sure if a 1 and 20% investment, and again, in the PFM summary, the median is 15%, not 20%, but PFM feels that it's warranted because of the possible excess returns and the quality of the returns. Anyway, I do have some concerns about the investment, and I wanted to make sure everybody understood that.
What does OCIO?
That's instead of for example, Chris acting as a CIO, PFM has many clients who they actually operate as the CIO for, right? It's called an outside chief investment officer, right? Alex, you could correct anything that I'm wrong about on that.
It's referred to as outsourced chief investment officer, otherwise known as discretionary investment management. Don, I believe Mark had spoken with you about this concept in the past. Fran, I do want to address that. We conducted a complete open process for this search. We conducted due diligence on over 20 firms. We spoke with 6 firms, and with complete open mind. We had, a team of, Floyd, myself, 2 dedicated alternative investment analysts from PFM. And at the end of the day, after this, this open process, it was the view of us, and I don't want to speak for Chris, but I believe along with Chris that, Golub was the top firm. And, we were constantly making evaluations. We evaluated Golub Fund 12 for our clients, both consulting and discretionary. We evaluated Golub Fund 14 on a completely independent process of that. We're not in the habit of going with the same firm. We're not in the habit, we're in the habit of recommending the best firm that we know of for this situation. And, after a second review, independent of any other process we've done, it was our team's view that was Golub from an investment standpoint. warranting the fees. Again, they're below average management fee, maybe slightly above average performance fee. That structure is in line with what we look for, again, in terms of lower management fees. We'd rather see the back end, come through. In your question about why alts, why now, maybe that's certainly applicable. And if we were looking at venture capital or opportunistic real estate, or even sector funds in the buyout space, there would be a lot less to talk about. But right now, I think we're sitting here looking at fixed income approaching a negative 2% return on a year to date, with the prospect of rising rates, early next year, if mid next year, with Fed tapering starting in the near term. So we're looking at this right now. The investment policy statement is improved, and that's a guidepost. The ranges are wide, and we're within those ranges. But we still believe that right now, moving ahead with a private debt allocation sourced from fixed income makes sense for this plan right now.
I understand that you're within the ranges of the IPS, but let me also be clear that being within the ranges of what's in the IPS is not a free ticket or carte blanche for the consultant to say this is what you're doing, period. There was one firm that presented to the commissioners, and that was Golub. You may have reviewed 6 or 20 firms. Chris may have reviewed a handful. The commissioners heard from one. The commissioners received data concerning one. So to me, that is the essence of an OCIO sort of operation, where the commissioners are being told, well, out of the 20 firms that we reviewed, this is the one that you get to pick from.
If I just want to step in and say that was the guidance that we were given in the framework.
I understand, Alex. I'm not saying you did anything. I'm not saying you did anything wrong. I'm not saying I'm saying why I have hesitancy on this.
Got it.
That's all I'm saying. I'm not saying anyone did anything wrong. I'm not saying it. To me, it has the feel of an OCIO model where one option is presented and it's a thumbs up or thumbs down, and that's all I'm saying. So anyway.
So just a few follow-up thoughts on that, and that also to follow up Fran on what you just said. I think on the city's bigger pension plan, the trustees do get 2 or 3 choices. So that could be something that we could discuss moving forward, I would think. I think that's where Fran is coming from there. Did he just step away for a second? Yeah, okay.
He made us aware of the fact that he did have a possibility of someone delivering a refrigerator.
Oh, okay. So I think though, if we're talking about the investment itself, so are we saying as a group that on the diversity side, we're comfortable monitoring them, but we need to, and we're not quite, I think that's what I hear, but we need to talk about the investment. Is that what is going, is that where we are right now?
I think that's where we are.
Okay. And when we approved an allocation in alternatives, hi, Fran. No, that's okay. I think you're muted. Fran's muted. Okay.
Yeah, sorry about that. I had to let the guy in to look through.
No, that's fine. That's fine. I was just saying that for point of reference, that on the city's bigger pension plan, the trustees do get 2 or 3 choices. And so maybe that's something to consider going forward, that it be set up that way, just so that there's more dialogue and input from the trustees.
Yeah, Rebecca, and I think why that's important. Public equities are a little bit different to me. Private equity, private debt, things like that. That I think that would be true.
Mm-hmm. Yeah, I think that's a good suggestion. I do. I think that would strengthen the process. So I would be in favor of doing that going forward. I think, Fran, going back to the months of conversation we had on adding a small portion of alternatives, and you mentioned though up to 20%. Did you say that? Because that,
I did not say that. I
Okay.
believe I believe it's up to 7 or 8%.
right, okay, okay. Now this investment itself though is very small, right? And maybe this was covered. This was 9 million, right? It would be 1.35% of assets.
Yes.
How does this fit? How would this fit into the overall allocation? Like, what are you thinking, or how did you figure that size recommendation?
So that's within the context of the alternatives allocation. So the recommendation and approval was for a 7.5% target to alternatives, and that's alternatives as a whole. If you recall, when we were presenting, our concept of what that would look like, it would be a balanced portfolio of, real assets consisting of things like real estate and infrastructure and maybe some farmland, et cetera, oil, gas. It would be consisting of private equity, traditional leverage buyouts, middle market private equity, maybe some venture capital, and then it would consist of private debt. A core senior secured private debt investments like Golub, bolstered by either focused private debt, that's real estate private debt, or something more mezzanine, et cetera. So it's, again, it's this within each of the sub alts classes, there's a core and satellite approach. So, we're kind of extrapolating what those numbers would look like. We get to, for the first core investment of the private debt subsector, roughly a 1.35% allocation. And that takes into account, the fact that Golub calls capital quicker than their peers. Part of the nature is, when you're investing in these private vehicles, they call money over time. So it takes time to get up to that, that target level as well. So, that was how we backed into the 1.35% number.
Okay.
And it would, assume that there would, if we're continuing along this plan, that 1.35 is designed with the idea in mind that going forward basis, there would be continued commitments to new funds and strategies over time across all the buckets. And the sourcing for this would come from, as I mentioned, traditional fixed income.
And I get the outlook on fixed income. I think we all understand the outlook on fixed income, Alex, and I don't think we disagree with the muted prospect of fixed income. However, even if muted, fixed income it close to zero or slightly negative is still a ballast against a down market. Make no doubt about that. Now, to have private equity as a substitute for the ballast of fixed income is concerning. I mean, there's no guarantees in private equity. I mean, there are. Now we can look at track records, but we can look at track records for anything. So the fact that it's being used not as an alternative asset to increase, like a venture capital, let's say, to increase the total return of the fund, but it's being used as a substitute for something that's traditionally a ballast to down markets, that's a little bit concerning to me.
I think I see your point and I understand where you're coming from. And you mentioned, part of the solution in your response. That's why you conduct diligence on certain firms, and that's why you examine, years and years of track record. You look hard at the people that are conducting it, and you look hard at what we know, and what we know is what they own right now. We're able to see that, and so, the same could be, at the same time, we know what we're holding in, traditional fixed income assets is going to, like I said, we know that will be challenged if rates rise. So I think it's sort of maybe, keep the asset allocation, and it's a volatility dampener. It'll be a headwind if things continue the way they are. It may be a downside protector if there's a sudden and extremely long-term correction. I don't expect Golub to perform significantly differently in those types of situations.
Hey, Alex, Floyd. Hey, Alex, it's Floyd. Can I add a couple?
Yeah, go ahead.
A couple of sentences. Frank, so to answer your question, also, think about the fixed income. You already know you're not going to basically earn any real returns over the next 5 years. This would actually be private debt, so it would replace that. And also in regards to the loaning process, yes, banks are lending, but they're doing more residential lending, not so much business lending, which is the biggest difference. Business lending, bridge lending, they're not doing as much as that as they had done in the past. That's where and why firms like Golub have been able to, essentially, gain more and more of that market going forward.
Thanks, Floyd.
Man, I'm gonna tell you, since I've been chair, for the most part, we've kind of voted, unanimously for just about everything that we've considered. And although I haven't asked for a vote, Fran is really voicing concerns, and I would think that maybe we need to pause here because of his discomfort with this process. So Rebecca, I'm not sure where you are. You want to comment on that?
I think that, we're saying that right now the conversation is not truly around Golub, but around asset allocation and process, right? So I think that it could be useful to have a special session of this board on asset allocation, so that Fran is part of that, and that there can be just more buy-in with whatever direction we're going in. I think that could be helpful. Then to move forward. I do know, this is some time ago at this point, but my office, we had talked around that the allocation to alternatives came about, that there was a lot of conversation around that the PGW pension fund had not met its expected return on investment, and that we needed to have some mix of alternatives to get there. And then there was a lot of debate back and forth where my office said, well, there should be two conversations, one about what the expected return on investment should be, what the assumed rate of return should be, and then whether we should invest in alternatives. And, the city's larger pension plan has done very well on alternatives. So I think that I got comfortable, and my office got comfortable with the allocation to alternatives, being that it remained small, and considering the success we've had in the larger plan on that type of investment. So Fran,
Yep.
that was sort of the process, but I do think it could be helpful to have a session on that, so that we're all on the same page with the overarching plan. And then even if it sets us, quote, a step back, then as we see Golub, as we see then other investments, we can understand and have buy-in in the overall approach.
Yeah, and I appreciate that, Rebecca and Don. And just as way of explanation, because I know this is not convenient, but the best thing, Rebecca, that that you did was reduce the assumed rate of return down to 7%. I mean, that was your initiative, and I remember that. And by the way, this is not being done as a vacuum. I know I'm a designee on this board, but this is not being done on my own. I can tell you that. This has been discussed in this year. Maybe the person who was in this seat previously was not active in this seat and may not have read the information. I don't know. But, our annualized return since inception through October 31st is 8.65%. Right. Our assumed rate of return is 7%. That's with zero alternatives. And I get it. I mean, before Alex or Floyd say anything, and I don't know why I feel like I need to be on the defensive, but I do feel like that, is that before you say anything, I get the outlook for fixed income, right? I've said it numerous times already. But 8.65% annualized return, 7% assumed rate of return with zero alternatives for a fund that is roughly 76% funded. Why would we pay additional fees for alternatives and take more risk? I know it's been the best returning asset in the municipal fund, but without, and Rebecca, you said this earlier, and I agree with this, without the process being enhanced, I'm not as comfortable making that commitment right now. So that's really the way I'm looking at this,
Yeah.
just in general.
I mean, I think it might be worthwhile to have a separate session and go through and look at, we can look at an updated asset allocation output. Fran, I definitely see your point. And I think, the question you'd have to take back is, what's our tolerance for volatility? Because if you were to look at that as of the end of March 2020, quarter end, all the reports would be horrible. And now we certainly know that period has passed, but it's, can we stomach that type of volatility? Because I think I'd have to remind myself, but given our capital markets assumptions, even a 7.0% return requires a solid amount of equity. I think we're still looking at least 60 to 65% equity targets over the long term to achieve that return. And with that amount of equity, that invites that volatility. And I think the conversation we had about 2 years ago was, where else can we go for risk adjusted or volatility adjusted returns? It led us down this road. Certainly if depending on what happens in a given year, the equity markets can wag the entire portfolio. And, this was part of a way to still achieve the target return, continuing to bring it down as able to. Every other year, every several years, till we get to a point where, that equity, that can be achieved without, with a minimal equity risk or a much lower equity risk and thus volatility.
Yeah, and we've been hearing for a couple of years, right, about assumed rates. We've been hearing that, wow, the outlook for returns, and this is at least 2 years ago, maybe 3. The outlook for returns are dim. Everyone has to reduce their assumed rate of return, quickly, and that look, it lowers the hurdle, right? Reducing the assumed rate is a good thing. It lowers the risk. It makes it easier to attain or surpass your assumed rate, but look at the returns the last couple of years since people have been saying that. So I think you never know what's going to happen with the market. So I think I would be comfortable revisiting that issue briefly, but more importantly, as Rebecca said, revisiting the process to make the commissioner, at least me in this role, more comfortable saying, well, yes, out of these firms, firm A was the best, and I think that I would like that.
So
we're on board with that.
We're going to table a decision on Golub, and we're going to revisit our philosophy as it relates to these types of investments. But I would ask Christopher to make certain that in his communication with Golub, that they understand that this decision really had nothing to do with them. It's a philosophical discussion that we need to have. Okay? Is it okay if we move on?
Yep, happy to communicate that, Don, and appreciate the feedback from everyone. I'll reach out. I know we have, several holidays coming up, and, I'll reach out to gauge everyone's availability for a special meeting, or if they just want to do it as part of the regular January meeting. I'll, get feedback from folks on their availability and such for that. So.
All right, thank you very much.
Yep.
The next item on our agenda is investment performance update.
Yep.
Sure.
I just wanted, Alex, just real quick, I just wanted to mention, I'll let Alex and Floyd PFM go through the numbers. I did just want to mention that as of this morning, there's roughly $693.3 million in total fund AUM. That includes just under $7 million in cash. That's a rise of roughly $8 million in total since the October, numbers that you'll see there. And that $8 million rise also includes the fact that we paid out, roughly $2.2 million in benefits. So the numbers have, the funding has gone up about $8 million in the last couple of weeks. With that, I'll turn it over to Floyd and Alex.
Yep. And I think Floyd has an appointment, so he unfortunately has to jump right now. This is as of the end of October. Since we last met, I think the last time we spoke, markets in the U.S. and overseas were exhibiting some volatility towards the end of September. I think Facebook was hauled in front of Congress, and that led to some volatility in the tech sector. Some concerns about slowing in China led to worse performance in international equities, as well as some, large cap domestics tied to China. Following the end of September, markets were very strong in October and into November. There's been a lot of discussion around inflation. What are the impacts on markets, et cetera, going to be? As we saw through September into October and now November, when the strong year-over-year prices were written about, have been all over the news. Stocks continued to move ahead. Data came out for consumer spending last month, which was surprisingly exceeded expectations by about 0.5% of growth rate. I think it's the strongest month-over-month increase in 9 months or so. And consumer demand remains high. So in face of rising prices across a variety of markets, demand is high, sales are high. We're certainly going to be looking at the holiday sales season for further indication of how consumers might be reacting to this. Labor market is another market that still remains volatile. We've seen signing bonuses and wage increases. We've also seen large number of resignations. I believe the unemployment rate has started to tick back down at a faster rate. Toward I think it was late summer, things leveled off, but the last 2 jobs reports saw unemployment begin to tip down at a faster rate again. But again, people are still removing themselves from the job force. You probably heard about Great Resignation and whatnot. It's looking like there's a number of factors contributing to this, just like there are a number of factors contributing to the supply backlogs across the world. One of them we're looking at, people have experienced a little bit more freedom, flexibility, and they have some savings. So in that regard, again, it's something, a temporary, misalignment of what's going on. And we expect over, 12 months plus, just like, many of the other goods markets, the labor market, will, start to show signs of normalization. So in the face of all that, the plan has continued to do quite well. The net return for the month of October up 3.7%, ahead of the benchmark of 3.5. The 1 quarter return you can see also in excess. And then on a year-to-date basis for calendar year 2021, up 13.5% versus 11% for the benchmark. Combination, certainly overweight to equities throughout this year, despite some periods of volatility. But also some, good contribution from active management. Go through some highlights. PineBridge, missed its benchmark for the month by about 0.5%. It's right on top of the benchmark, slightly ahead year to date, right on top of the benchmark for the last 1 year, and still lagging since inception. So we are continuing to move ahead with the search. I think we have our final 2 calls this afternoon, and we'll have some deliberations, but I do expect we will move forward with bringing some names in front of the commission early next year as a replacement for PineBridge. On the small cap side, Copeland has, they've had a volatile year relative to their benchmark. Good performance this month, close to the benchmark for the quarter. Year to date, they're outperforming and lagging, as you can see, over the 1 year. So they've been, exhibited again some volatile performance relative to their benchmark. So far this year, recovered. Rumbline, the S&P 600 index, on a year-to-date basis, outperforming the Russell 2000, quite nicely. 24.17 versus 17.19. So again, the decision to go with the relatively higher quality S&P 600, as expected over longer periods, we would expect that to be beneficial. Moving on to international equity, again, if you look on the year-to-date column, the active managers have, done quite well. Both Acadian and Ernest. Ernest had a bit of a miss this month. They're lagging slightly for the quarter, but again, we've come fully back to terms with Ernest. No concerns with them. Moving onward to the fixed income, this is where some active management as well as some spread sector allocation was a detractor for the month. Year to date, the combined fixed income still outperforming the Barclays aggregate by about 100% or so, for 50%, down 0.71 versus down 1.58. But you'll notice again this month, I think spreads widened somewhat in the corporate and high yield sectors. So the MetLife investment credit and the Sky Harbor were detractors, whereas most of this year they have helped the fixed income component, quite a bit. So all in, the plan continues to do very well. Again, the overweight to equities is certainly a driver, but a lot of the managers we've put in place as a group over the last several years have done well over longer market cycles. PineBridge still being the one exception. We're taking a look at that, and we hope to have some updates soon. So I'll just leave it up for any questions.
Alex, not to I know we have a lot of busy folks, so maybe just 30 seconds or 60 seconds. I know this has come up before, certainly something we talk about at the big fund. I would say staff here at the pension fund, Fran, we talk about it almost daily. I'll admit, while I expected inflation to be a problem, I don't think, I know, I did not expect it to be this much of a problem this quickly. I know that, PFM had a pretty strong view about it being transitory, perhaps even more I'll say dovish than, my view. Just given what we're continuing to see, whether it's with energy prices, I don't have to tell anyone who goes to the grocery store once a week what certain prices look like. Used car prices. I mean, just kind of everything across the board. Has PFM's investment committee or the consulting staff, I mean, do you have a modified view? Is it still the same? Are you expecting this to ease by, next year? And again, 30, 60 seconds is fine, but, what's the current outlook from
Yeah, so I think our original view was 12 to 18 months, and that was probably back from April or May of this year. I think that is still our view. I guess that's not transitory. To me, that is transitory, but I'm looking at, as opposed to a decade of, inflation or stagflation. And the same goes, I think, for the labor market as well. So, 12 to 18 months. I think we would have a little more concern, Chris, if, again, consumer demand and consumer sales weren't as strong as they are, especially during the one period where we were told that it was the most shocking price increases. So we're certainly going to, it's one of the number one things we're watching. We're going to be watching consumer habits as well, as well as corporate habits, skimpflation or changing, consumption habits. They're kind of the two sides of the same coin. We'll see how much that impacts sales, et cetera. But right now we're looking at, like I said, maybe around this time next year, we might be expecting more normalized climate.
Okay.
So Alex, let me ask a question. If this problem with inventory getting to the stores will certainly impact overall sales, right?
Yeah, it's expected, yeah.
And I don't know the magnitude of that problem, but is it possible that when aggregately the interpretation of growth in the economy could be negatively impacted by this this inability to get inventory to the market?
I don't think overall, like, it's going to dip us into a recession. There are areas of the economy that are, doing quite well as a result. I mean, right now, so far, corporate profits remain strong. They seem to be passing the prices along to consumers with no impact to demand. I know that certain segments of the economy are experiencing record profits as a result of certain backlogs. So I don't think this is recession predicting. If anything, again, a lot of things are we're tied into supply and demand balances. You could argue that demand for employment maybe has gone down. At what point does demand for employment begin to rise again as people erode their COVID savings fund they had built up? And that's why, again, we think that market forces will prevail over a timeline of originally 12 to 18 months. We wouldn't be surprised if we're still looking at this 6 to 12 months from now, like I said, on the ending frame.
Got it. Thank you.
Don, you mentioned supply, and I'll just give an aside here. So I just ran up for the refrigerator repair guy, and I know this is an aside. He said luckily he had the part, so he's going to make the change. He said if he didn't have the part, he had to order one the other day. You know how long it took he said it would be the end of December before he would get the part. It's for a refrigerator. It's not for a luxury item. It's a refrigerator, and it's interesting. He said the supply chain is so backed up, and they can't get help. They can't get workers to work. So it's a real thing. It's interesting what's going on now.
Yeah,
I own several apartments, and my apartment manager indicated, he said, Don, if a refrigerator goes out in one of these apartments, it's going to take us 6 months to get a new refrigerator.
Yep.
That's scary, But
and at the same time, though, anecdotally, we've deferred some repairs to our home, but we've also and we're doing a low key, low value Christmas. Not a lot of goods this year, but frankly, we're planning a lot of road trips and things. So again, we're looking at areas where we don't look at changing habits this year, and I think there'll be a lot more data, a few 3 months from now about where people are spending and where people are going to may be drawn back into the workforce for what kind of incentives.
Hope so.
Yeah, I not to belabor it, but Fran and Donna, I share that concern. I mean, even something as simple as a new phone, I got a new phone within the last couple of weeks, and many of them were on back order until literally would not ship until the end of December. And that's for a phone. And I know that there's microchips and other issues, and that leads into whole other discussions about, national security concerns because of microchips and where they're made. But I think you're both your concerns are both well founded there, both based anecdotally and then just larger on the knowledge you have. So I'm with you both on that.
Can we, so I would assume that we're comfortable moving on to item number 4 on the agenda.
Yep, I believe so, unless Rebecca or Fran have anything else on that. No new business from me other than, again, I'll reach out over the next few days, and being cognizant of the various holidays we have coming up, about a special meeting or just doing it in January. And I will reach out with that message to Golub, Don, this afternoon, with the backdrop that you suggested. Obviously, if folks have things they want to discuss about the process, the investment, other managers we looked at in the interim, don't hesitate to, give me a call or shoot me an email. I'm happy to do that.
Thank you, Christopher. I just have one question for Alex. Alex, are you still there?
Yep.
I just hadn't heard you all discuss the merger acquisition or whatever. How are things going over at your firm?
They're going well. The merger is proceeding as planned. We, all of our, new office locations have been mapped out. I think almost every single person is moving over, from top to bottom, investment professionals and non-investment professionals alike. We've talked, with our, some of the new colleagues at US Bank about, actually ways how we can enhance their existing investment, processes. But otherwise, from my standpoint, things are, fairly consistent. So it's still moving ahead. I would say no meaningful developments that will impact, you all.
Excellent. Any other questions before we adjourn? All right. Is there a motion for adjournment?
I'll make a motion to adjourn.
All
I'll
right.
second the motion.
So moved. Thank you very much. Enjoy your
Thank
day.
Thanks,
you.
everyone.
Hey,
Have a
Rebecca
good-
and Don, thank you. I appreciate your patience with that other issue.
Of course.
right.
Thanks. Bye-bye.
Thanks,
We
everyone.
appreciate your expertise. Have a good one.
Have a
All
good
right,
week.
take care. Everyone have a nice
Thanks, everyone.
Thanksgiving.